So good morning, everyone. Thank you for joining our Dean's Forum today. My name is Dan Hamilton. I direct the Center for Transatlantic Relations here at SAIS. And we're working with Dean Nasser to put on this event today. It's going to take the form of a conversation between the Dean and our guests. So I'm going to ask them to come up in just a second, but let me introduce them before we go ahead. I think our Dean, Vali Nasser, needs no introduction here at our own school, but for those who are joining us from the outside, Dean Nasser, Vali Nasser, is both a scholar of international affairs and a prominent commentator on international affairs. He's been the dean here for a number of years. Before that, he was a professor of international politics at the Fletcher School at Tufts University. He also served as special advisor to the President's Special Representative on Afghanistan and Pakistan. He has served on faculties of any number of other universities and research institutes. And he's going to engage today with Marco Alvera, who's the Chief Executive Officer of Snam, which is a European leader in the construction and integrated management of natural gas infrastructure. Mr. Alvera has had his career in the energy industry, but he started out working in private equity and M&As in London, where he also got his degrees. But he's worked for any number of other energy companies, various sectors, for Enel, Eni, Wind Telecom, Gas Naturally, and Eurogas. And Snam has been working on a report, which they call the Global Gas Report 2017, which they're releasing today here. So this is new information. We have copies of the report outside in the lobby. It's also, I understand, on the Snam website, so you can get an electronic copy if you'd like. There's both an executive summary and a fuller document for you to read. So without further ado, I'm going to ask our two speakers to come and join us, and as I say, we'll have a conversation and then go to questions and answers from the audience.
Well, good morning, and thank you very much, Dan, for helping put together this great event, and also for your generous introduction. Mr. Alvaro, it's wonderful hosting you here at SAIS and to hear your thoughts on both the energy sector and gas, and also the geopolitics of it. So let me begin by asking you, what are the most important findings and highlights that we ought to take away from the Global Gas Report? And I know you've been in Washington the past few days, and I've been talking to varieties of policymakers and energy people, and I'm sure they've been asking you the same thing about where do we need to focus on the gas sector now?
Thank you. Thank you very much for having us here. So we thought we'd do a gas report, mainly because a lot of the reports are about oil and gas together. And oil tends to steal a lot of the limelight away from gas. Gas is more complex. Natural gas means different things to different people, whereas oil means oil to everyone. There's international prices, there's liquidity. It's kind of really a global market, whereas gas is getting global, but is still very much a regional market. So what we wanted to do, given we are focused just on natural gas, is produce a report that would talk about the trends and the challenges of the gas industry on its own. And gas is really at an inflection point. We went very quickly, since we've been working in this sector for the last 15 years, we went very quickly from a situation of scarcity. In 2006, we had the Ukrainian crisis. We had a world where there was not a lot of gas left. And now we're in a situation of abundance of gas. There's been not only the shale revolution, but huge discoveries in East Africa and the Eastern Mediterranean. And how those reserves are going to come into the market is a question of infrastructure. So the real challenge for the gas industry is around the infrastructure and debottlenecking some of the existing infrastructure, and at what speed we will develop new liquefaction infrastructure. So some of the key findings are that there is growth in gas, a lot of growth, of course, fueled by the lower prices in the US, a lot of growth coming from Asia, big question mark on how quickly the Chinese market reaches its objective of significantly increasing the penetration of gas. This will have a big impact on the global LNG pricing. And then, because we're based in Europe, there's a focus on Europe where gas isn't having such an easy ride, because there's a lot of people who see gas just as a transition fuel, which prefer a rush to renewables as opposed to giving gas its space in the energy mix. And so there's different perspectives depending on what we look at. One of the key issues has to do with the cost of infrastructure and the cost of liquefaction, which has experienced an incredible inflation. A project in 2005 would cost $200 per ton, and some of the more expensive projects last year were commissioned at a cost of more than 10 times that. If you take out the outliers, the average cost is still around $800, $600 per ton. So you're still looking at something which is 3 to 4 times more expensive than what we had in 2005. And so that's going to have, and is having impacts on the pricing of LNG. I think one of the key questions, and we can address this in as much detail as you like, is the whole question of US LNG coming into Europe.
Well, I think you're describing a market that is broken up based on the cost of infrastructure and access. And so do we need sort of think that the United States for the foreseeable future will have an energy advantage based on the low cost of not just getting the gas out of the ground, but also distribution in the US, as compared to, say, the cost, for instance, for other big producers like Qatar would be, or similarly that Russia would have a disproportionately advantageous cost structure with Europe compared to, say, Eastern Mediterranean gas?
So I think, yes. So if you look at domestic policies and the impacts on the broader economy, certainly having low prices is giving a big advantage to anything that has to do with manufacturing to the US. So if you have Henry Hub at $3 and you have the European gas prices at $6 or $7, whoever's building something that's energy intensive, whether it's steel, whether it's glass, whether it's automobiles, is at a disadvantage to the United States. And so I think that's becoming more and more part of the European energy policy, is how do we lower this gap? When there was concerns about scarcity, price was secondary, and I think now that the scarcity question has kind of gone away, the question really is around pricing, and the answer has to be to create a more liquid market in Europe, to make Europe a little more similar to the US, where you have an abundance of infrastructure onshore so that you can move gas around from state to state. You can have a deeper market, a more liquid market, and this is really the only way to really create that competition that will lower prices. The ability to rely solely on US LNG for Europe would mean that Europe is locked into a price disadvantage, because by the time you liquefy, and this is shown in our report, by the time you liquefy and you transport and you regasify, the $3 Henry Hub goes back up to $7, which is not helping the competitiveness of Europe. So the key question is, how do you become more competitive? We think storage is going to be playing a key role in gas storage, is going to be playing a key role in the industry. We have a lot of strategic petroleum reserves everywhere in the world, but not many people focus on strategic gas reserves. And given how fragile, or how much more fragile the gas market is and how much less liquid the gas market is than the oil market, we think we need to invest in additional gas reserves. Just to give you an idea, in Italy we have 30% cover. That means we have around 30% of the demand in the form of reserves. And in places like China, you have a lot less. You have a much bigger market with a lot less reserves. And in the UK as well, the amount of storage has been diminished significantly. So the question is, when the LNG market is becoming more and more liquid, with more supply coming online, it will become very seasonal, because all the LNG demand is in the northern hemisphere. Korea, Japan, China, India, Europe, they're all above the equator. And we use gas for winter, for heating. The difference between winter gas and summer gas in terms of volumes is 4-to-1, 3-to-1. And so if you cover the winter, in the summer you're going to be left with a lot of excess availability. And unless you have storage, you're not going to really be able to use and exploit that excess liquidity. And so storage is necessary both to balance the market out and to allow Europe to capture some of the opportunities that will be available in the summer. We've seen summer gas, LNG, come into Europe at low prices, probably around $4.50. So that was not probably very profitable for who was selling it into Europe, but if you don't have an alternative, you're going to have to go where you find the storage.
So, a few years back, we heard a lot about Eastern Mediterranean gas, and actually when we had Paolo Scaroni and then Claudio Descalzi, who both came here in capacity as CEOs of Eni, they talked a lot about the company's investment in Africa for development of gas. So where does African gas and Eastern Mediterranean gas fit in?
So Europe is in a very unique situation, because Europe has this gas price which is quite high, has production within Europe that's declining very rapidly, and Europe, I think we have a map somewhere that maybe we can project. If you look at the if you look at the at this map, you see how the red lines are the big import corridors into Europe. So Italy is the most interconnected gas country in the world, because we have direct pipeline coming in from Algeria, direct pipeline coming in from Libya, we have the red pipeline coming in from Russia, we have pipeline going into the north, that's for Norwegian and Dutch gas, and we're building the southern corridor coming in from the Caspian Sea, across Turkey, across Greece, across Albania, into Italy. So Europe needs to increase its imports significantly because of its declining indigenous production. We are assuming in our outlook stable North African flow when it comes to pipeline gas. That's Algeria and Libya. Certainly there is a tremendous opportunity in the whole East Med. There's been massive discoveries in Israel, even greater discoveries offshore Egypt, and part of that will be certainly LNG, and part of that, the Israeli part, still needs to find a home. Whether that gas gets liquefied, whether it comes to Europe through a new East Med pipeline, whether it goes into Turkey with a shorter pipeline, that's all a question for the owners of that gas and the buyers, prospective buyers of that gas. The costs vary significantly. So if you look at a pipeline to Turkey, ballpark, you can expect from Israel $1 billion. If you look at a liquefaction plant using public data, that's probably around $5 billion. If you look at a pipeline coming all the way into Europe, that's probably double that. So from a pricing perspective, you're probably better off going straight into Turkey. If you want to have more flexibility and diversity of sales, you're probably better off with the liquefaction. So I think North Africa is going to continue to play a big role in supplying Europe with natural gas.
But these let's say, the Eastern Mediterranean African gas, in terms of BTU cost, how do they compare with the U.S. LNG?
So if you take any publication that looks at upstream, whether it's CIRA or Wood Mackenzie or IHS or some, the upstream costs, and we have some data in our report, the upstream costs in these regions are significantly below the Henry Hub. If you have a traditional onshore producing large gas field, you're probably around $1 or something like that. And the cost of pipeline transport is significantly less than LNG because you don't need to liquefy it, put it on a ship, and regasify it. So the industrial cost is a big advantage. Then you have a lot of taxes that come into the game. You have significant export taxes out of Russia. You have transit fees that Algeria has to pay to cross Tunisia. Certainly new infrastructure is more expensive than amortized infrastructure. You have very different geologies. So some of the more complex offshore fields where there's high pressure and high temperature are going to be costing a lot more than the onshore fields. But I think we remember prices in the US were below $2 when we had onshore traditional sources of gas.
But for the foreseeable future, Russian gas will be the cheapest.
Yeah, I think the solution for Europe is to really get out of the situation where we have, if you look at that map, we have kind of still 25 fragmented markets. And you can see there's an abundance of infrastructure in the north, but if you just look at France, there's no real way to interconnect Spain to France or southern France to northern France. And if you look at Italy, those red pipelines are coming into Italy, but we still don't have an ability to move gas out of Italy, which we will have. So to lower the prices, you need to create a real liquid market that's sending price signals to whoever sells into the market. If we have a fragmented market, then all the pricing power is left with the suppliers, if I may. So the European Union is focused on the energy union as its project to get rid of these bottlenecks and create more liquidity in the market. If you look at the theoretical cost of any of the sources, whether it's Kurdistani gas, whether it's Azerbaijan gas, whether it's Russian gas, whether it's Norwegian gas, whether it's Algerian gas, the actual cost structure is a lot lower than the prices that we're paying today.
So geopolitically speaking, at least in terms of the way in which Russian gas acted as a leverage for Moscow in managing Ukraine or influencing European politics, has Europe's dependence on Russia lessened?
I think to be totally open, the relationship has been a very successful relationship. The gas has always been flowing. The leverage is one of mutual interest. So there's quite a healthy balance there, as there is with any of the gas projects. There's a saying that oil is about dating and gas is more about marriage. When you build these pipelines, you need to have that long-term relationship there, and I think it's been a successful one. I wouldn't really be concerned about the leverage. Certainly, transit countries are an issue for who has gas. Transit countries are an issue for Algeria when it has to come to Italy through Tunisia or has to go to Spain through Morocco. Algerians have been thinking long and hard, how do we avoid Tunisia and Morocco? They went so far as building a direct pipeline. If you look at the map, that blue line between Algeria and Spain came after the older line going through Gibraltar. That's a way to, and they were going to come into Italy through Sardinia for a very expensive project. So I think if you own the resource, you want to be able to access your market directly without an intermediary, and I think that's
so this allegory of marriage sort of raises interesting questions about the direction Turkey is going with Europe.
Yes.
So politically, when we read about migration, human rights sets of issues, we're seeing a parting of the ways between Europe and Turkey, and its politics now looks to be more focused towards the east. But yet, if even in addition to Southern Stream, if the Eastern Mediterranean pipelines also go through Turkey, where do you see the discussion about Turkey's relationship with Europe going, if you looked at it through the perimeter of gas?
I only look at the gas perspective, so I'm not involved in the broader political discussions, but I certainly see Turkey gaining significant influence as a consequence of the gas that will be flowing to Europe through Turkey. Turkey will have gas coming to Italy from Azerbaijan with the TAP and the Southern Corridor. Turkey already has the Russian gas coming to Turkey, but right now that's ending in Turkey. If it starts flowing out of Turkey, that's an additional lever. Turkey already has Iranian gas coming into Turkey. Eventually, unless, as and if things get solved around northern Iraq, there's significant gas resources there that are very cheap that could make their way to Turkey. And the Israeli option of sending gas to Turkey is certainly an option that's on the table. So you'll get, whether it's 4 or 5 or 6, or whether long term, there's a lot of gas coming from, could be coming from Turkmenistan. Potentially Turkey becomes the hub, the entry point for that southern route, which is a necessary route because the North Sea is declining very rapidly. Holland is declining very rapidly. German production is declining. Italian onshore production and offshore production is declining rapidly. So Europe needs to increase its imports by 30-40%, depending on the demand outlook. And LNG is not going to be the only option because of the pricing point I raised earlier. So that southern eastern corridor is very important for Europe. Will make Italy a gas hub, but it's also going to give Turkey a lot of additional leverage compared to what they have today.
So what is the level of investment that's going in right now in terms of infrastructure in Turkey and connecting Turkey and Europe?
So if you take the full cost of the southern corridor, and we're only involved in the last mile, the last bit that goes from Turkey to Italy, which is called TAP. So TAP is around a $5 billion project, but the whole corridor, including upstream cost, is maybe 10 times that. So there's significant investments that are being made. It's a corridor that is today about the Azerbaijani gas. And there's additional prospective projects, whether it's Turkstream 2. There's a project called Poseidon that's also planning to come into Puglia, into the south of Italy. What we have done as Snam is we've upgraded our infrastructure so that we can export gas out of Italy. We've invested a lot in the north of Italy. We've reversed the flows of our pipelines so that we have the opportunity when gas comes in to export. We will be fully operational with this in 2018. But we've seen, as I said already this summer, some LNG coming into Italy because of the storage that we have.
Now, we haven't talked much about this, the Middle East gas beyond Kurdistan, the large reserves in Qatar and Iran. Are they, do you see them as being important to Europe, or they're going to be mostly focused eastward?
No. Qatar has been a strategic supplier for Italy. We have one of Europe's most functioning regasifier is near Venice, offshore Rovigo. We recently bought a stake in that regasifier, and we expect the supplies to continue to come from Qatar.
But that's tanker supply or
LNG?
LNG on tankers.
LNG on tankers coming in. Iran is already supplying Turkey, not very significant volumes, but there is a connection there. Certainly, if you have so much infrastructure already in place as Qatar has, it makes sense to continue to develop LNG as opposed to pipes. And there's going to be a lot of LNG demand in China, a lot of LNG demand in India. There's a whole set of new LNG markets emerging, whether it's Pakistan, whether it's Bangladesh. FSRUs, so floating regasifiers, are really opening up opportunities for a lot of LNG in Asia. And as climate change becomes important, LNG and gas is really the only concrete available alternative to reduce both CO2 and particulate.
So thinking about this sort of the pipeline politics and infrastructure going east, let's say the Iran, Pakistan, India gas pipeline, or now pipelines potentially being built right through the Rakhine state in Myanmar, which is directly involves the Rohingya issue. What is the level of, how important are these, and what's the level of investment? And is that the way that, one ought to think of the future of gas supply to Asia?
I think if you have sources that are accessible with a pipeline, the pipeline is always going to beat LNG from a cost perspective. The LNG becomes competitive over longer distances or when you want to have a diversity of opportunities. But wherever you have that ability to have that marriage, the pipeline is always going to be a cheaper and a more viable opportunity. Pakistan is a huge growth opportunity for gas. They were hoping, and they are hoping, to get a pipeline from Turkmenistan across Afghanistan. Of course, you go again into that transit country situation, apart from the security concerns around Afghanistan. Do you want to have an intermediary if you're Pakistan? And I think because the border with Iran is a direct border, that potentially is an easier pipeline to be built. Otherwise, Pakistan will be building floating and regas and be importing LNG. Because with the growth in the economy and the growth and appetite for electricity, and with the electrification going on, gas is the only quick way to bring electricity to the country.
So I had heard that countries like Qatar, for instance, actually subsidize regasification or LNG terminals, and in some countries, and that is having an impact on decisions in the recipient country. And first of all, how significant that is, and whether you think that's a sustainable model here.
I don't know if they're technically subsidizing or if they're financing. I think there's a real difference. I think we've seen a lot of people willing to finance energy projects if it helps them get the resource. So we've seen a lot of China financing Africa to get the oil, and I think you could do the same for the gas. And we've seen historically Russia help finance some projects to get demand. And so a lot of these projects historically have been financed with long-term take-or-pay contracts or commitments, which is, you could argue, it's a source of subsidy. It's easier, and the only way to get these big projects is if you have a seller and a buyer committing volumes, and then you can go and get it financed. If you have a degree of sovereign financing, I think that could be rational for a sovereign state wanting to increase its expenditure. And it would be rational for a country like Europe to, if you go to Israel and say, we'd like you to build a $10 billion pipeline to come to Europe instead of a $1 billion pipeline to go to Turkey, well, Israel's going to say, help me finance that, or how do we finance that? So I don't know if it's a subsidy or if it's a kind of a financing. Certainly, once you get the financing done, the operating cost of this infrastructure is not that high, and so it's competitive.
Well, when I worked on Afghanistan, and it's been subsequently the case, everybody, at least as a talking point, put the future of Afghanistan on the pipelines that would come from Central Asia through Afghanistan, and then perhaps go through to India as well, and help create that marriage. And I think still the president of Afghanistan used that as a talking point. But in reality, actually, Pakistan has been relying on Qatari financing, which is the facts on the ground actually doesn't support the vision for the future of Afghanistan that everybody was focused on. And one could see down the road, you end up having kind of energy relationships that are built that undermine sort of the grand vision that's being put for an economic relationship between Central Asia, Afghanistan, and the region. And you mentioned China as well, and I've seen also in your report the level of demand going up. So in particularly thinking about the U.S.-Chinese economic competition, how quickly do you think LNG may likely, or natural gas may likely, change the economic direction in China, impact prices, but also essentially address some of the issues they have around coal and
Yeah.
the current energy consumption?
So I think we think China will achieve its stated target to at least double the penetration of gas in its energy mix. Today, gas accounts for about 6% of the overall energy mix, so it's very low. To double that means to creating another 200 billion cubic meters of additional demand, which is, a lot of it is going to be coming via LNG. We see storage as a key enabler to that because LNG demand will be very seasonal over time. And it's not only about the CO2. I think in China it's really about the air quality, which is a much more urgent and pressing issue for local and national politicians. And the push for electric vehicles with electric cars fueled by electricity made with coal is not going to be a clean option. So the first thing is to clean the way you make electricity. And I think gas in vehicles and gas in transport is a big opportunity for China. They already have 7,000 natural gas filling stations. And in Italy, we have one of the world's largest natural gas vehicles fleet. We have 1 million natural gas cars on the road already. And I think China's looking at this with some interest as to how natural gas can bypass diesel and work alongside with electric vehicles as a path to decarbonization, as a path to cleaner energy. So that's true for trucks, true for light vehicles, and also true for consumer vehicles. So I think the solution is going to be a palette of opportunities, but we really see China being able to achieve its target of at least doubling the penetration in the energy mix. And even if it gets to 12%, it's still going to be a lot less than we have here and we have in Europe. In Italy, we have around 35% natural gas penetration. So there's a long way to go for China as it seeks to improve its air quality.
Interesting. Okay, let me turn to members of our audience, and if you would introduce yourselves. I think there's a question there in the corner.
Is it working? Oh, yeah. My name is Ralph Mamadov. I'm a SAIS alumnus and former representative of SOCAR here in the United States. My question will be regarding DESFA. As you know, SOCAR had that failed process where the privatization didn't take place. Now DESFA is bidding for Snam is bidding for DESFA. How do you see that process going, and what drives that intention to privatize DESFA?
Yeah.
And the second question will be about the Gazprom and Nord Stream 2. You mentioned that all the upstream projects come from declining from the Northern Europe, and Nord Stream 2 is targeting Northern Europe with those two branches of the pipeline. How do you see that process going, and how will that affect the plans of Europe to unify the gas market?
Okay, so for Greece, it's public that we are interested. I think the privatization has something that started a long time ago. It's part of the package of reforms that Greece is pressing ahead with, successfully, I must say, because I think there's more and more good news coming out of Greece. Because of what I said earlier around Turkey, Greece and Italy will be interconnected through TAP. And DESFA should be part of an interconnected and integrated gas market. And so our ambition is to participate in the privatization. It's a competitive process, so there's not too much I can say at this stage. But we are together with other partners in a consortium, and it's a interesting region and an interesting asset for us that will help Europe, going to your second question, achieve this energy union, which is about having the abundance of infrastructure, like you have in the US, that can allow the gas to really freely flow within Europe without any restrictions. And Nord Stream 1 is already up and running, so it's a successful project that's, it's not diversifying the source, it's diversifying the route. I must say that we are also investing time and energy in Ukraine. We have a MOU in place with Ukraine. So I think, again, you're going to be looking at a number of opportunities, a number of different routes to continue to bring Russian gas, which is a big part of the European gas mix. It's about 30% of the gas mix.
First, let's try the other side. Go ahead.
Thank you. My name is Austin. I'm an MA student at the Elliott School. You mentioned Libya as a major source of natural gas in North Africa. Can you speak to if that dynamic shifted with the political instability post-Gaddafi, like how that changed, if it changed at all? Thank you.
So I must say, if you look at the data, the flows that have come into our network have been quite stable throughout. And I think this is true of most of the flows. Once you have a pipeline in place, we see the flow of Qatari gas going into UAE is there. The flow of Libyan gas coming into Italy has been stable throughout. We hope and we expect it will continue to be stable. Certainly, as Libya recovers, they will be consuming a lot of the gas for their own needs, which is good news for Libya. But the pipeline is there, and it will make sense to keep it up and running. Thank you for the question.
This gentleman first, this with the beard, and then next to him. Go ahead.
Hi, my name is Misha. I'm a master's student at Elliott School as well. My question was about Algeria. They've made certain changes recently to an investment law, and their new oil minister has been talking about increasing market share in Europe as a priority. But at the same time, most of their production is coming from some aging supergiant fields that are really in need of renovation and are seeing declining production. Do you feel that it's plausible that Algeria could increase market share in Europe, or is it more likely to stay around where it is or even decline?
I think Algeria has liquefaction infrastructure, so it's one of very few countries that has the luxury of being able to choose, and we see they are playing their spare capacities. So if you look over a 4 or 5 year period, the volumes coming to Italy have fallen. This is public data. They have fallen significantly, and they've increased again. If you look at the volumes going to Spain through the different pipelines, they change quite significantly. So Algeria has this luxury of being able to use different export routes and different export options for its gas. I've read about this objective of increasing market share. I think this is good news for us and for Europe. I don't know the specifics of the competitiveness of the additional resources. They have some exploration programs that are underway, but we're not involved in the upstream part. But I think it's a stated target, which is a helpful target for Europe as we have to cope with this declining indigenous production.
And there's a question right next.
Hi, thank you. My name is Jack Anderson. I work at FTI Consulting in the Energy Strategic Communications practice here in Washington. I'm curious to know what kind of communications and advocacy challenges are you seeing in Europe, especially with regards to the LNG regasification terminals that are in the planning process, as well as new storage and pipeline infrastructure that obviously is very much needed?
Yeah. So the communication is something that the gas industry hasn't been very good at. And the renewable movement is a lot more powerful and vigorous and well organized. And so there's a trend in Europe that you don't really see here in the US, and you certainly don't see in other parts of the world, which is to think of gas as a negative fossil fuel as opposed to an opportunity for environmental issues, which is a paradox given Europe is still burning a lot of coal. And so we certainly haven't been as good as our friends in the electricity sector that openly talk about banning diesel from the big cities in London and Paris and other cities, and they think of replacing that with electric vehicles in the next 15 years without really asking the question where the electricity is coming from. And Europe has seen such a surge of renewables because of subsidies. So Europe spends more than $20 billion a year subsidizing renewables. And so gas has been compressed between this growth in renewables, which is good. There's nothing wrong with renewables. They're excellent when they work. And the growth in coal, because as shale gas displaced coal in the US, cheaper coal made its way to Europe. So this paradox where you're subsidizing renewables, but you haven't really reduced the CO2, and in fact you've increased the particulates that are coming out of coal. So I think part of the challenge, and I think we're working very closely with a number of the upstream companies, with Eni, with Total, with Shell, around the gas advocacy to really make a case. And in the US, you have a lot of ads for gas. The gas is good. You don't have any of that in Europe. So I think we have a lot of catching up to do. It's challenging, but I think the case is so strong, and part of the reason we did the report is really to get the facts right around gas. Now, there are issues with gas. Methane leakage is an issue. We're very glad to hear Exxon is going to address that issue head-on through XTO. It's more of an upstream issue than it is a transport issue. But I think as an industry, we need to keep the dialogue going, and the CEOs of the energy companies signing a declaration in favor of carbon pricing, I think, is very good in that direction. I think there's a lot that will be happening on transport, as I mentioned. With the diesel scandal breaking out, people are finally seeing the full cost of diesel from an environmental point of view. And natural gas is an immediately available solution to address that. If you have a gasoline car, you can retrofit it to natural gas with $1,000, and you're basically on zero emissions from a particulate perspective, and half the CO2 emissions that you have on diesel.
Let me just quickly follow up with in the context of at least electricity generation in Europe, how does this sort of natural gas fare against the debate around nuclear power?
Yeah, there's a resurgence of nuclear in the UK with Hinkley Point, and there's a new nuclear technology that EDF is building and exporting into the UK. I think there's going to be some decommissioning beginning to happen, and so I'm not sure whether nuclear will increase its market share or at least stay stable. I think stable is probably more likely, where you replace some of the older generation with new generation. I don't see it as a lot of growth, because in Italy we passed a referendum, so nuclear cannot happen, and the amount of NIMBYism is very vibrant in Europe. We have difficulty in building an underground pipeline that has no emissions, has no impact, has no health concerns, and you still get opposition to it. I think it's, regardless of the costs, which are an issue in today's new nuclear build, but regardless of the costs, regardless of the energy policy, there's still going to be a lot of local opposition to building new nuclear facilities.
This lady here in the front.
Hi, I'm Deborah Kagan, until recently the Senior State Department Fellow here, and I've been recalled to the State Department for some unknown reason. But so a couple of things. First, on the environmental piece, I totally agree with you. Whenever the European energy people come here from the EU or the Commission, and we tell them that based on the switchover to natural gas in the Commonwealth of Virginia, there has been a lowering of carbon emissions by 48% over a 2-year period. In some states, it's as high as 60%. So that's an enormous drop. And so a number of states in the United States are meeting carbon emission standards, whereas Germany just announced last week it's falling 40% short for the 5th year in a row, and they're burning 10% more coal than they did. So I think that's a really good point. And I wish when the Europeans came here, they wouldn't be mouth agape and surprised by this. I mean, this is, from, no one wants to, these days you're not supposed to use the word climate change, but whatever you want to call it, the numbers, because of the transition to natural gas, are way down, and that's significant. And in fact, you have many of the states in the United States achieving goals that Europe is hoping to achieve 10 years down the road, and they're achieving them now. So I think that was an excellent point. I want to go geostrategic for a minute. And I think it's good that you talked about all the diversification of sources, but the Russian piece, as this gentleman mentioned before, is still worrisome, because It is our view that Russia will continue to undercut the market in order to gain more market share. They don't play by the same rules, and I believe that there's enough of the sort of bureaucrats within the EU who will look at the third energy package differently for Russia than they might for someone else. Under the Trump administration, the U.S. is very, very interested in shipping large amounts of LNG to Europe. And the floating terminal in Lithuania just received its first U.S.-produced gas delivery in late August. And we think there's a lot of these independent energy producers, I'm not talking about the big guys, but the independent energy producers are very interested in this, including looking at upstream investment. What's your view about upstream investment in the United States, something Japan has been doing for years?
Okay, thank you. You touched a number of points. I can only say that keep the dialogue going with our partners in Europe, because I think Europe has a lot to learn from the US. Germany has about 12 billion euros of yearly subsidies on renewables that are going onto the household bills. So it's keeping the industry out of that. But they have this increase in coal, which hopefully stops, because Germany also has, and Italy has, a lot of spare capacity in gas. Because before the resurgence of coal and renewables, they were running on gas. So the plants are already there. We don't even need to build the CCGTs. The combined cycles are being mothballed and taken off the grid because they're simply not functioning right now. So there's really a paradox that has to be talked about a lot more. When it comes to undercutting, well, I think if you're a European consumer, you don't really mind if the price is being undercut, if that's true. I mean, what you really want is to have the cheapest possible access to energy. And what I was saying before, if we've had customers go off our grid, so either go bankrupt and shut down manufacturing, or moving manufacturing to the US because they can't compete paying natural gas $7 instead of $3. They just cannot compete. If you're making tiles or glass or steel or cars, you can't compete. So the option of relying on US LNG, if the independent producers you mentioned or the larger companies want to keep their investments profitable, they need to sell US LNG at Henry Hub +4 or +5. And so, if the Henry Hub's at 3, gas has to come at 7. If the Henry Hub goes to 5, has to come at 9, 10. That's not going to be helpful for European competitiveness. So we've had US LNG come into Italy. That's great news. We're going to have a lot of flows in the summer. That's great news. It's certainly going to act as a ceiling to Russian gas, which is also great news, because if the Russians or the Algerians or the other suppliers keep pricing up, LNG will come to a point. So US LNG will be a ceiling for European prices, which is very good. But it's not going to be the base load solution for that manufacturing competitiveness that I talked about. The third energy package, I think, is very helpful. We exist as an independent company because of the third energy package. The process of creating independent infrastructure, I think, is a transparent and healthy path that Europe has started, and I think we'll subscribe to.
Excellent. This gentleman, both of them, first gentleman, this one, and then next you can pass it on afterwards.
Hi, I'm Nikos Tsafos, and I teach a class on natural gas here at SAIS. I wanted to ask about risk and infrastructure development in sort of two contexts. One is, obviously, a company like Snam, most of your revenue is sort of from the regulated side. So I wanted to get your thoughts on the success of the regulatory regime and sort of incentivizing infrastructure and the ability to get more infrastructure going. The second one is a little bit different. It's about sort of risk in a broader sense. I was interested when you said Turkey and Israel, if the buyers and the sellers figure it out, that's great. And I wanted to get your thoughts on sort of where does SNAM fall into the development of infrastructure. You look at something like TAP, it was really driven by the producers, then at some point, after it was de-risked to a certain extent, infrastructure companies sort of came in and bought off equity shares into the infrastructure project. So is there something that's missing in terms of allowing infrastructure companies to be more on the development, earlier in the development side, and maybe pushing the kind of projects that some of the producers might not, and therefore unlock potentially new infrastructure that isn't happening right now?
Yeah, so the risks around the infrastructure. Well, let's say the regulatory risk is a risk we have to deal with, but it's a good risk because in our sector, the real risks have to do with commodity prices and volatility in prices. And regulation tends to be stable, and the regulator tends to incentivize companies to do their investments and to keep the network up and running. What makes me comfortable is that we make less money on our investments in a regulated environment than we do in a non-regulated environment. So if I invested $100 in America, you get a 10% return, more or less, if you invest in greenfield infrastructure. If I invest $100 in my own network, I get a 6% return. So there's no pressure for the regulator to push that down further. I mean, it's kind of below market, but it's still an interesting return for my investment. On a project like TAP, I can get a higher return, and it's backed by a long-term contract, which I like more. SOCAR and BP and the shippers are very creditworthy. And so do I prefer a kind of a 10% return with a creditworthy counterpart for 20 years, or do I prefer regulation? I like both. I can live with both. But so long as I don't take any real commercial risk, I don't have to take a view on what the price of the Henry Hub or LNG in China will be in 20 years. So that's a luxury for us. And that allows us to step into big projects if we have these conditions to take that risk. I think we would have stepped into the Southern Corridor day one. So all you need is a shipper pay. And all you need is a seller willing to finance that, but they're not really financing that with cash. They're financing that with a long-term commitment. And I think that's the nature of these projects. Now, for LNG, it's harder because if you're an LNG buyer, prices have gone down from $15 to now $4 or $5. You're going to be a little reluctant to enter into a very long-term relationship now. Maybe in a few years when the prices are a little more predictable and stable, that's going to be different.
Hi, Chris Goncalves. I lead the energy practice at BRG, Berkeley Research Group, and SAIS alum as well. I wanted to pick up on several different themes you've spoken about regarding market liquidity, hub pricing, and natural gas supply competition amongst various importers. In light of the declining conventional production in Europe, in light of the increasing liquidity, actually, of hubs throughout northwestern Europe, particularly NBP, TTF, but also coming on strong and very linked to TTF, NCG and Gaspool in Germany, PSV in Italy, and so forth. There is arguably a basis there for substantial liquidity in northwestern Europe or Western Europe, coming on less rapidly at the periphery of Europe, Spain, Eastern Europe, Northeastern Europe, and so forth, where oil indexation remains prevalent. But looking ahead to a more liquid European environment, as you suggested, the critical thing for pricing will be which is the marginal source of gas coming into Europe. And so my question for you is, in the future, in a more liquid environment, would it be US LNG exports, other LNG exports to Europe, Gazprom pipeline supplies, and/or Algerian pipeline supplies? I won't use Norway because of volume and declining production, but that are most likely to set marginal prices in the European market environment. Thank you.
Excellent. That's. I don't have the crystal sphere. I wish I did. You're certainly very right. We have a functioning liquid market in the north. The price differential between NBP, TTF, Zeebrugge, NCG, or Gaspool, there's none. It's basically like the same differentials you have in the US. So Northern Europe is fine. Southern Europe, because we're still unable to interconnect Spain and France, because of opposition in France mainly, and because we are unable to interconnect southern France to northern France because of French issues, because we're unable to export gas out of Italy, and because you can see it on this map, Eastern Europe is an orphan of the South Stream. The South Stream was meant to come in and interconnect all these countries. They haven't been interconnected. So Eastern Europe is a little more challenging because it requires hundreds of millions or billions of infrastructure that someone has to finance. But the creation of Spanish, southern France, Italy, Greece, and kind of Austria as a hub that's integrated with the north, I think that's easily done. That's what we're working on. We're a $30 billion company. We're going to be investing seriously in the reverse flow to get gas out of Italy. We hope to be able to invest to bring Spain and France together. And if we succeed in Greece, that will help also interconnect the full Greek network with ours. So I see signals are there. We're moving in the right direction. The marginal cost will be LNG. And so I think LNG, and it will be the cheapest LNG. So I don't know if it's going to be Qatari LNG or US LNG or Egyptian LNG, which is a lot closer. But LNG will be acting kind of as a ceiling in the winter. And so no one with pipeline gas will be able to price above the LNG in the winter. But it's going to be a floor in the summer, because I seriously expect a lot of distressed cargoes available in the summer, coming to us because we have the storage. So as you get those distressed cargoes in, they will be taking away market share from pipeline gas. And so they will be undercutting or underpricing because they will be desperate to land somewhere. And so I think the prices are going to be kind of in these boundaries, and you're going to get this kind of LNG price movement between summer and winter that will be impacting the European. But because we have storage, we can kind of modulate that a little. So you have really the marginal competitor to pipeline gas in the winter is going to be the LNG that you've stored in the summer, if you see what I mean. And so then it becomes a kind of opportunity cost for the traders who will have played that seasonal arbitrage.
Very good. I think maybe one more question there from.
Thank you for your presentation. I'm Kento Yoshimura, first year science student. My question is about what do you think about the forecast of the destination clauses in Asia market?
I think destination clauses will tend to be something of the past. Destination clauses were designed for people to divide and conquer the different markets. But as the markets become more liquid, they are hard to justify in European law. In fact, European law has forced an abolishment of the destination clauses. And if I'm a buyer, I'm certainly reluctant to accept a destination clause because it limits my ability. And because of the seasonality I mentioned, there's going to be a rush towards storage. And so people may be willing to take the gas, store it, and then take it back in the winter.
So, copies of the report are available here. Please join me in thanking our guest, Mr. Alvaro, for a wonderful conversation.
Thank you.